EBITDA looks simple, clean, and impressive, but in many real businesses, it hides more than it reveals. EBITDA. EBITDA is widely used but widely misunderstood. Let's break it down clearly. EBITDA shows how much money a business makes from its core operations. It ignores loans, taxes, and accounting costs like depreciation. So it gives a quick view of business performance that makes it useful for comparing companies with different structures. The problem starts when people treat EBITDA as the only important number. It's convenient, but it doesn't tell the full profit story. EBITDA is not cash, it's not true profit, it's an adjusted earnings number used for analysis, not decision making on its own. Understanding what's excluded is more important than memorizing the formula. Interest shows the cost borrowing. Taxes are real obligations. Depreciation represents assets wearing out over time. Ignoring these costs doesn't remove them, it only delays when you notice them. A business can show strong EBITDA while struggling to pay suppliers, handle debt, or replace equipment. This is common in capital intensive or fast growing companies. On the surface, EBITDA looks healthy, but real financial pressure may be building underneath. Cash flow reflects timing. When money comes in and goes out, EBITDA ignores timing completely. Businesses don't operate on adjusted earnings, they operate on cash. A business still has to pay some of these costs in real life. For example, loan interest. You must pay cash on to the bank. Taxes, you must pay the government. Depreciation shows real wear and tear on assets. Ignoring it assumes assets last forever, which almost never happens. In such businesses, EBITDA can make performance look much better than it really is. Two companies can have the same EBITDA but very different risk. It, if one has a heavy debt, EBITDA doesn't show financial pressure. You need to look at the balance sheet for that. EBITDA isn't bad, it's a tool useful when used correctly. Problems happen when people treat it as the full picture instead of using it to support deeper analysis. People often misuse EBITDA by relying on a single number for complex questions. Smart analysts always ask, what's missing here? Asking the right questions is more important than chasing better metrics. Numbers only tell the full story when paired with context. Start with the EBITDA, add cash flow, review the balance sheet, assess sustainability. This simple framework keeps analysis practical. It works for freelancers, checking clients and founders, evaluating their businesses, and students building financial intuition. If these questions make more sense now, there's progress. Real financial understanding comes from thinking, not memorizing. EBITDA makes things simpler, but simplicity has limits. Strong decisions come from looking at the big picture, not just one number. If this helped you see how EBITDA really works, that's the goal. Future videos will keep breaking down business and finance concepts in a clear, practical way. Thank you very much.